What if I told you that after analyzing hundreds of dividend ETFs, only 3 came close to perfection? And here's the plot twist that's going to blow your mind. The one everyone said was the absolute best is actually losing in 2025. I'm about to shatter some myths and show you the shocking performance numbers that Wall Street doesn't want you to see. And trust me, you're not going to believe what I discovered. Look, I spent weeks diving deep into dividend ETF data because my own portfolio needed answers, and what I found completely changed how I think about dividend investing. Everyone's talking about dividend ETFs right now, but here's the problem. Most people are making the same costly mistake. They're chasing last year's winner instead of building a strategy that actually works. By the end of this video, you'll know exactly which 3 ETFs form the holy trinity of dividend investing, and why one surprising fund is absolutely crushing the competition this year. Spoiler alert, VYM just dethroned the king, and when you see these numbers, you're going to question everything you thought you knew about dividend investing. Let me tell you what makes a dividend ETF almost perfect, because it's like finding the perfect investment partner. They need to be reliable, affordable, and actually deliver on their promises, not just talk a good game. After analyzing the entire dividend ETF landscape, I discovered 3 funds that meet what I call the 3 pillars of dividend perfection. First, ultra-low costs, and I'm talking about all 3 charging just 0.06% annually. That's only $6 per year on every $10,000 invested, which means you're keeping more of your dividend income instead of paying it away in fees. Second, massive scale. Combined, these 3 manage over $250 billion in assets, which gives you incredible liquidity and institutional confidence. Third, and this is where it gets really interesting, they have completely complementary strategies, meaning each one solves a different piece of the dividend puzzle. Let me introduce you to the contenders. First, we have SCHD, what I call the Quality King, offering a robust 3.74% yield from just 103 hand-picked companies that pass strict financial strength tests. Then there's VIG, the Growth Machine, which requires companies to have increased their dividends for at least 10 consecutive years. No exceptions. And finally, VYM, the Diversification Champion, spreading risk across 583 holdings, spanning every major sector of the economy. Each one has its own personality, its own strengths, and its own role to play in a perfect dividend strategy. Now here's where the story gets absolutely fascinating, and I mean this is going to change how you think about everything. For years, SCHD was the golden child of dividend investing. YouTubers praised it, Reddit practically worshipped it, and everyone said it was unbeatable. Financial advisors recommended it, bloggers wrote love letters about it, and it seemed like SCHD could do no wrong. But 2025 just flipped the script completely, and I mean completely turned the dividend investing world upside down. Let me show you the numbers that are making investors question everything they thought they knew about dividend investing. In 2025, VYM is leading with a stunning 11.81% year-to-date return, absolutely dominating the competition. VIG is holding steady with a solid 8.36 to 9.57% gain, proving its consistency once again. But here's the shocker. SCHD, the former king, is struggling with just 2.38 to 4.13% returns. This isn't just about one year's performance. This complete reversal reveals a fundamental truth about diversification that most investors completely ignore. The underdog became the champion. The steady performer stayed consistent, and the former king learned a hard lesson about concentration risk. Let me tell you SCHD's story, because it's actually a really important lesson about quality versus diversification. SCHD built its entire reputation on quality, and I mean serious quality. Only 103 companies make the cut, and they're screened for financial strength metrics like cash flow to debt ratios and return on equity. It's like having a private investment committee choosing only the absolute cream of the crop from American dividend payers. The methodology is brilliant, the execution is flawless, and the concept is sound. But here's the problem that caught everyone off guard. Concentration can be a double-edged sword that cuts both ways. SCHD's 19.23% energy exposure became an anchor dragging down performance when oil prices stumbled and energy companies faced headwinds. Sometimes being ultra-picky and concentrated backfires spectacularly, even when your selection process is theoretically perfect. But here's the thing. Don't count SCHD out yet, because quality doesn't just disappear overnight. That 3.74% yield is still the highest of all three funds, and get this, 95% of its holdings maintained or increased their dividends this year. The fundamentals are still solid, the companies are still high quality, and the methodology is still sound. This is just a reminder that even the best strategies can have rough patches. Now let's talk about VIG, the growth machine, because this fund has one beautifully simple rule that creates extraordinary results. You must have increased your dividend for 10 consecutive years, period. No exceptions, no special circumstances. It's like an exclusive club for dividend aristocrats where the membership requirements are absolutely non-negotiable. This isn't just about current yield. This is about proving your commitment to shareholders year after year, decade after decade, through good times and bad times. This strict screening process led to an incredible 18.3% annualized return over 5 years, which means that $10,000 investment became over $23,000. That's the power of focusing on companies that consistently grow their dividends rather than just paying high yields today. While VYM stole the spotlight this year, VIG's steady 8 to 9% gain proves that consistency beats flashiness over the long term. Companies like Microsoft and Broadcom in the portfolio benefited massively from the AI boom, showing how dividend growth companies often lead innovation and technological advancement. But the real story of 2025 belongs to VYM, the diversification champion, and this victory teaches us something crucial about investing. VYM's approach is beautifully simple and elegant. Take the higher-yielding half of all dividend-paying U.S. stocks and spread the risk across 583 companies. It's like having a piece of every major dividend payer in America, from tech giants to utility companies to financial institutions. There's no fancy screening, no complex methodology, just broad, diversified exposure to American dividend payers. While SCHD suffered from concentration and VIG stayed steady, VYM's diversification became its secret superpower in 2025. The fund's 21.8% allocation to financial services caught the interest rate wave perfectly, as banks benefited from improved net interest margins and economic stability. This is a perfect example of how sometimes the quote-unquote boring choice of broad diversification beats the supposedly smart choice of concentration. VYM proved this year that you don't always need to be clever. Sometimes you just need to be comprehensive. Here's the beautiful part about these three funds, and this is where the magic really happens. You don't have to choose just one of them. These three ETFs are like puzzle pieces that fit together perfectly to create a complete dividend investing strategy. Each one addresses different needs, different risk profiles, and different market conditions. Based on the 2025 performance data and what we've learned about market dynamics, here's my updated allocation strategy that balances all three approaches. I recommend 40% in VYM as your foundation, because it's proven its diversification advantage and is currently leading performance. This gives you broad exposure to dividend payers across all sectors while maintaining that solid 2.51% yield. Then 35% in VIG as your growth engine, because despite this year's relative underperformance, its long-term track record of 18.3% annualized returns over 5 years is simply too good to ignore. Finally, 25% in SCHD as your income booster, because that 3.74% yield and quality screening process still provide the highest sustainable income of the three. This combination gives you everything you need: current income from SCHD, future growth from VIG, and protection from sector-specific risks through VYM's diversification. It's like having a financial Swiss Army knife that works in any market condition. Of course, you can customize this based on your specific needs. If you're more income-focused and need higher current yield, You might increase SCHD to 50%. If you're more growth-focused and have a longer time horizon, you might bump VIG up to 45%. The beauty is in the flexibility. Now let me give you the reality check because I called these funds almost perfect for a very important reason. No investment is truly perfect, and 2025 proved that even the best strategies can surprise you in ways you never expected. The key lessons from this year are absolutely crucial for any dividend investor. First, diversification beat concentration when it mattered most. Second, sector allocation matters way more than most people think or realize. Third, and this is critical, past performance doesn't guarantee future results, no matter how compelling the track record looks. But here's what I've learned about real perfection in investing. The closest thing to perfection isn't finding the one supposedly best ETF and putting all your money there. True perfection is understanding that these three funds complement each other beautifully and being willing to adapt your strategy based on what the market teaches you. It's about building a robust system rather than chasing the latest winner. Each of these funds brings something unique to the table, and together they create something much stronger than any individual fund could achieve alone. If you're serious about dividend investing and building long-term wealth through dividend income, these three ETFs absolutely should be on your radar. But remember, and this is crucial, it's not about picking the supposed winner for next year. It's about building a comprehensive strategy that works in all market conditions, whether we're in a bull market, bear market, or something in between. The goal isn't to predict which fund will win next year. The goal is to position yourself to benefit regardless of what happens. Which of these three funds surprised you the most? Was it VYM's complete dominance this year? SCHD's unexpected struggle despite its quality focus? Or VIG's steady consistency through changing market conditions? Drop a comment below and let me know what your current dividend strategy looks like, because I read every single comment and love hearing about your investing journey. If this deep breakdown helped you understand dividend ETFs better and gave you a clearer picture of how to build a winning dividend strategy, smash that subscribe button because I'm diving deep into more investment strategies that actually work in the real world, not just in theory. I'm constantly analyzing market data, testing strategies, and sharing what I learn with this community. Remember, the best dividend strategy isn't necessarily the one that performed best last year or even this year. The best dividend strategy is the one you can stick with for the next 20 years, through market ups and downs, through changing economic conditions, and through all the noise and confusion that Wall Street throws at you. These three ETFs, SCHD, VIG, and VYM, make that kind of long-term sustainable dividend investing not just possible, but almost effortless. They've each earned their place in the Dividend Investing Hall of Fame, and together, they're about as close to perfect as dividend investing gets. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.